In 1929, the stock market infamously collapses, right? And one of the greatest collapses in all of history, right? So we need to talk about why the crash happens. What happened was that prices got so high that sometimes some big market players, I'm talking like Joseph Kennedy, John F. Kennedy's father, are going to play they're going to play the game that they think it's gone as high as it can go and it's going to start falling. So they're going to play a bear market game, betting it's going to fall. There are ways of making money on the stock market in a falling market. It's called selling short, and it's the best way to do it. Selling short basically means selling something you don't own for a delivery at a future date. There are a lot of different ways to do it. For example, let's go back to that RCA stock that I talked about. It went up to $505 a share, and let's say you're looking at the RCA stock, but you're like, you know what, that stock's going to start falling. So what do? You're going to go and you're going to borrow 100 stocks, 100 shares of RCA to go out and sell. You tell the broker that you're going to bring them back in a month. And you don't own them. You're just borrowing them, right? Now you immediately go out and you begin selling them at the current price of 505. Now, what are you going to have to do in one more month, right? You're going to have to buy them back to the original broker to get repaid, right? But suppose the price had gone down from $505. You're going to make a killing. You borrowed 100 shares at no cost and sold it at $505 a share, right? A month later, let's say the price goes down for each share by $300, right? It goes down to $200, right? So basically what you're going to do is you're going to buy them back. You're going to give them back to the broker, but at the current price of $200. And so you're going to sell it back at $200, but you bought them at $500. That's a difference of $300. Well, guess where the difference goes? Back in your own pocket, right? It's an easy way to make money off of nothing. Here's the point about selling short. If you're an ordinary guy and you hear a guy like Joseph Kennedy is selling short, you immediately begin to sell. You can't risk it. Now, what happens when enough people begin to sell? The prices begin to fall. And this is exactly what happens. The panic starts to take over in 1929 due to these things. And this is why it's called a panic. Stock prices were falling in September and October of 1929 all the way to 1933. It wiped out $40 billion worth of stock. Stocks like U.S. Steel went from $260 to $20 a share. Quite a few stocks just went off the board. They were completely worthless. Now here's something important. How many people really played the stock market? Not a large one, right? Only a small percentage of the wealthy were involved in the stock market during this period, not like today. So why should this crash in the small game help spark a depression? In no time at all, investors are going to begin cutting back. Consumers are going to cut back on their spending. This, of course, leads to jobs going away. And unemployment reaches as high as 15 million. Anywhere between 25 and 30% of the American people are unemployed. Why did the stock market crash lead to such a depression? The crash didn't eliminate the ability to produce or the need for consumers to consume. So what exactly happened? To understand it, you have to understand the fundamentals of the capitalistic system. If a capitalistic system is supposed to work, you need two different types of spending at high levels. You need investment spending, capitalist, rich people with large amounts of money putting their money into products, into companies to make money, like the automobile industry, right? You also need a reasonably high level of consumer spending. That is, you and I buying those automobiles. It is our job as good capitalists to spend our money as much as possible. I'm not joking. Both of these had begun to fall before the stock market crash. This is the dynamite in the basement of the building that I referred to in my previous video. Consumer spending and investment spending is related in a spiral fashion, right? If consumers create a heavy demand for something, investors are going to invest more in that industry. And that's going to create more jobs, which then gives these employees, consumers, more money to buy things. In the late 20s, consumer spending had already begun to decline. It had begun to decline due to the fact that the income and wealth in this country was going up, but it was over-concentrated in the wealthy. For example, in 1929, 91% of American families had incomes of $5,000 or less. All that prosperity, therefore, was concentrated in 9%. Too many people did not have enough money to buy things. So when consumer spending falls, those automobiles aren't being sold. So when your inventory is building up, you cut back on production, which means cuts back on employment. And you can see the relationship between the consumer spending and investor spending. Both consumer spending and investor spending began to fall well before the stock market crashed due to the overall weaknesses in the economy. So with all of these above features in mind, with the coming of the stock market crash, there comes a loss in confidence. And think about it. If you were about to invest in a big industrial plant, what are you going to do? You're going to wait. If you're one of those consumers, who are thinking about buying one of those new Model A's, what are you going to do? You're going to wait. And it's a downward effect. It's going to be a domino effect. So what do you think the stock market is going to do to the banks? This is where the stock market really gets into the economy. What happened to the value of the loans that those banks were giving brokers that bought stocks on margin? The values of the stocks disappeared. Do you suppose that people who had used the stock as collateral then just gave the money back the money to the bank to cover it? No, they gave the worthless stocks over. So banks were loaning people's life savings for something worthless. Now follow this. Let's say you're one of those people in the streets during the 1920s and you hear of the stock market crash. And someone tells you that they had heard from a lot of banks that they had loaned money for those stocks and those stocks were now worthless. Well, the first thing you're going to do, you're going to go run down to your bank and get all the money you can. Well, that's exactly what people do. There's going to be a run on the banks. But honestly, how much capital, how much liquid cash does a bank keep? Maybe about only 10%. So if everyone comes to the bank wanting their money, what's going to happen to the fellow who has his life savings and then he goes to a teller and the teller says, sorry, we don't have any money. Tough luck, buddy. Your life savings is gone. And it's never going to be returned unless somebody buys out the bank. And you're going to get pennies on the dollar for it. There's no insurance system on the banks then. And in 1930, more than 1,000 banks fall. In 1931, 2,000 banks will fail. Essentially, banking in this country was dead by 1933. With a banking system that did not work, the economy was unable to operate. This is key to throwing the entire country into a depression. Now, Hoover is going to say this about the Depression. The only problem with capitalism is the capitalists. They are too damn greedy. Pretty ironic because capitalism is based on greed. This is not being critical. It's how the system works. Just sometimes we push too hard and we get too greedy. Now, we do have restrictions on what banks can and cannot do with our money. But this can change with the right amount of support in Congress. Nothing is set in stone, and there are those today that are willing to do away with those restrictions. Now, what if you think about this thing like a spiraling downward? Consumer spending is falling due to everything we've talked about. This causes businessmen to cut back on their investment spending, which means a loss in jobs. More workers are losing their jobs, which means less consumers. This leads to the depths of the Depression. But if the economy is spiraling downward, it could also spiral upward. What could the President of the United States do to get its spending in the other direction? Even if the government uses government programs to get money into people's pockets, they still have to spend it. What happened was that the Depression mentality takes over, and people were so concerned about saving that when they got money, they didn't spend it. This only led to a worse depression. The economy goes down in the 1930s, from 1929 to 1933. And the effects of the Depression were tremendous on everybody and everything. It's really bad. 80% of the economy's stock market value, gone. Banks were wiped out by the thousands. Unemployment, as I said, anywhere between a quarter and a third of the population out of a job. There were millions of people who go hungry and actually starve to death. Can you believe that here in the United States? There are eyewitness accounts of men and women fighting over garbage being dumped outside the cities. Can you imagine what that's going to do to housing? I mean, we can all go out and buy a home, but during the period when people were losing their jobs and unable to pay their mortgages, foreclosures were going to start increasing, up to 1,000 a day. People were losing their homes. Divorce rates are going to increase due to the stresses involved. Marriage rates declined because you could not afford it anymore. Suicide rates in 1933 were 40% higher than it was in 1929. This is what the Great Depression was doing to way too many people.